Driving costs down is good for business, right? Maybe not. As supply chains get longer and longer and longer, businesses are exposing themselves to massive risks they don't even know about. That's the conclusion of our guest today, Professor Mohan Sodhi, who studies supply chain management. I asked him to tell me a little bit about what he'd been finding out.
Mostly I work in the area of risk, how companies are part of big networks and how that networks affects them and how they in turn affect other companies. So my big findings so far have been that companies are not very good at managing risk, they're not very good at estimating risk, and that they're not even aware of many of the risks they face.
So what was your key finding?
Key findings in terms of mathematical models are simply that there's a big gap between what can be done and what is being done. As far as empirical research, it seems there is a lot companies could do better in terms of managing risk.
So what sort of companies should be worried about supply chain risk?
I'm going to give you a politically correct answer, which means any company which has suppliers and those suppliers have other suppliers and those suppliers have other suppliers, and any company which borrows money from banks, those companies are particularly vulnerable to risk, and that means pretty much any company.
And if you weren't going to be politically correct?
I think starting from retailers onwards, every company is vulnerable to risk. Any company with long supply chains, with sourcing from Asia, sourcing from other countries, selling in other countries, these are particularly long supply chains that can break anywhere.
So what are the risks they face? What is the worst case scenario?
I can give you the example of Mattel toys. It's fairly recent and people with children certainly appreciate that. It was Mattel supplier who supplied the wrong kind of paint, using lead paint for toys that would be used by little children. And Mattel did not discover this until quite late. And those toys had already gone into the market. It resulted in a big recall, and so Mattel's consumers possibly had the threat of lead poisoning, and Mattel as a company lost face, and of course the entire supply chain in between, those supplier.
So in that case, how can companies protect themselves against that sort of eventuality?
To take the same example again, one of the German companies, like Playmobil, they make everything in Germany. So it's not that toys have to be made elsewhere and that supply chains cannot be brought under control. It's this continuous drive for efficiency, low cost, or higher profit margins that is driving companies to the farthest corners to source product, to make products. And what they lose in turn for those extra profits is control.
But what you're saying flies in the face of everything we know about globalization, because if you don't, as a company, source from the cheapest possible supplier, you're going to put yourself at a competitive disadvantage.
Yes, you've got to weigh competitive disadvantage in terms of lower costs or whatever against a survival of the company. So this is short-term versus long-term. And of course, with quarterly earnings, short-term focus becomes quite important. But there are obviously companies who have survived for 100 years, sometimes even more. And these tend to be family-owned companies who can afford to take a longer view. And they've survived. That means they made profits in the long run, but not necessarily on a quarter-by-quarter basis. And globalization also is not a bad thing. Globalization is a good thing. But globalization doesn't mean you have to make in the cheapest possible source without much control and then sell the products to only the rich markets. You can source products in China and sell them in China, and you can source products in Germany and sell them in Germany. There's nothing wrong with that. You can have global brands without necessarily having quote-unquote global supply chains.
But if companies believe that sourcing things cheaply overseas is essential to their business, what other steps can they take to protect themselves?
Sourcing overseas is hardly new. I mean, for hundreds of years, companies have been sourcing overseas. You can look at products even like China, porcelain. You can look at products like mining products or cotton grown in India but then made into cloth in Manchester. So global supply chains have always been there. It's the lack of control because of rapid growth of this kind of globalization, which is the risk. Not globalization by itself, it's the lack of control. as we saw in Mattel's case.
Has this all been made a lot worse by the financial crisis?
Well, the financial crimes illustrated a totally different type of risk which companies hadn't thought about. Banks are definitely in any company's financial supply chain. This is because banks provide working capital, banks provide loans for investment in new plant and equipment. And what we saw with the financial crisis was that buying overpriced homes in the US could affect a small company in outer London.
So from the research you've done, what's the one thing that's going to stay with you?
I think the thing that will really stay with me is being aware of the risks is much more important than anything else. And at least I haven't seen any sign that companies are fully aware of what they are into. There is always this optimism that we'll source at a low cost and sell high, buy low, sell high. And it's a little bit optimistic. The hard work that goes into creating controls, the hard work that gets created into doing the operations right and being environmentally sound, all those things somehow take a backseat to this optimism, sometimes unfounded optimism.
Professor Mohan Sodhi, thank you very much.